Listen up, folks. Time could be running out to lock in a historic yield at public.com. But you can lock in a 6% or higher yield with a bond account. Here's the thing. The Federal Reserve just announced a big rate cut, and the plan is for more rate cuts this year and in 2025 as well. That's good news if you're looking to buy a home, but it might not be so good for the interest you earn on your cash. So, if you want to lock in a 6% or higher yield with a diversified portfolio of high yield and investment grade bonds, you might want to act fast. The good news, it only takes a couple of minutes to sign up at public.com. And once you lock in your yield, you can earn regular interest payments even as rates decline. Lock in a 6% or higher yield with a bond account at public.com/investing unscripted. But hurry, your yield is not locked in until you invest. Brought to you by Public Investing, member FINRA and SIPC. As of 9/26/24, the average annualized yield to worst across the bond account is greater than 6%. Yield to worst is not guaranteed. Not an investment recommendation. All investing involves risk. Visit public.com/disclosures/bond-account for more info.
Hey everybody, welcome back to Investing Unscripted, where we ask and answer the hard questions about investing. I'm Jason Hall, joined as usual by my good friend, the voice of the people, Jeff Santoro. Hey Jeff.
Hey, how are you?
I'm good, man. Fresh back from a long vacation overseas.
Yeah.
I think anything's really changed while you were gone though, right?
Yeah, nothing is different than when I got on a plane at 8 p.m. on Tuesday, November 5th. Nothing was different. And from then to now, yeah, we were on a little vacation, got back Sunday afternoon. So happy to be back at the podcast here.
Yeah, it's good to have you back. And I want to say, this is another one of those special podcasts that's good for our listeners, but great for you, right?
Yes, good for the listeners because we have a fantastic guest, and great for me because that means you talk less. So without any further ado, we will introduce our guest today, Joel from the How to Money podcast. And before I get you, Joel, before you get a chance to talk, I just have to say this on the podcast for everyone to hear. This is a fun full circle moment for me because your podcast was one of the first I found when I became super, I want to say, obsessed with investing in personal finance things back in early 2020. And it was sort of like, once we started the podcast, it was one of the ones I wanted to grow up to be. So it's really great to have you here, and welcome.
Well, thank you. I appreciate that. Thank you for the kind words, and I'm glad to be here with you guys today.
So Joel, now I know who to blame.
This is why your podcast sucks, because you tried to imitate something terrible.
The podcast sucks because of Jason. All right, moving on. One of the things we usually do to start off when we have a guest is kind of have them give their backstory. But before we do that, one of my favorite things about your podcast is how you always start off asking your guests what their craft beer equivalent is, right? What's the thing they splurge on even while they're being financially savvy? So I want to flip it. I want to flip your opening thing and invert it. And I want to know, what's the dumb thing you used to spend your money on before you got wise and figured out all the personal finance thing?
That is a really good question. And for me, it was less of like an individual item that I spent too much money on. And it was just an emphasis on frugality that was overdone. And so I think some people, and I was one of those people for a long time, where personal finance was frugality. It was like, how can I cut? Yeah. And it was like, how can I save money in this way and that way? And so I'm going to frugal my way to being financially independent or something like that. And you pretty quickly realize, it took me maybe longer than the average bear, but you realize at some point, hopefully, that it's pretty darn hard to do that, and that there are other levers that you have to pull. So for me, I think my big miss, like how I was like super myopic, and I thought that if I just became more frugal in more aspects of my life, that's what was going to lead me to the promised land, to the place I wanted to be when it came to having enough money and knowing where everything was going. And I was too intent on that, and I was missing some of the other more important factors that personal finance has to offer.
Yeah, I was a little bit like that too, and it probably took me longer to kind of relax about it too. And I think the thing that did it for me was, as you get older and you start meeting more people at work and things, and you start to talk to people who are older than you, you start to hear those stories about the guy or the gal who saved a lot of money, retired to do all this traveling, and then died a week later. You never got to do any of it. And, so it's that whole balance between saving for the future, but also enjoying your life and going out and doing things you enjoy and things like that. So that makes sense to me.
to me, those are the worst headlines. Is the janitor that died with 8 million in assets or something like that, and you're like, I hope you enjoyed your job, and I'm glad that you were a good investor, but did you actually get to enjoy the fruits of your labors too? And I think that balance, it's really hard. Like it's so it doesn't make the headlines because it's not the FIRE movement. It's not someone retiring at 32. But I think that finding that balance is something that we strive to talk about regularly on the show, and it's something that I strive for in my own life. And it's just, it's not going to be an easy sell, I think, for a lot of people, but it's really important. It's what most people want out of life, and so they don't necessarily want to die with millions in the bank. They want to set themselves up for success right now in their everyday lives, but they also want to be planning for future success and creating future wealth for themselves at the same time.
Yeah, for sure. All right. So how about we dive into that usual first question? I came across your podcast when I just started to search for investing podcasts and personal finance podcasts. But I know that's not where you started. So why don't you give us a little bit about your background? Like, it sounds like you were always interested in the frugality aspect of personal finance, but how did you get to starting the podcast with Matt and getting to where you are now?
Yeah. So like my story with money really starts in childhood. And so I'll just quickly relate that my parents were not great with money. They argued about money a lot. And my parents are great people. They're actually like my heroes in so many ways, but so bad with money. And that created like a lot of
normal.
Yeah.
Normal people. Yeah.
Right. Exactly. So they argued about it. And I remember all those arguments. They filed for bankruptcy when I was 12 and our car got repossessed. And that stuck like left an indelible mark on me. And so I was always, that's, I think, where that hyper frugality got bred into me, was like, I don't ever want money to be this struggle. And I guess the only way to do that is to not buy a fancy new car or something like that might get repossessed that I might not be able to pay for. So I'm going to pay for all my cars in cash, like that kind of thing. And I still pay for all my cars in cash. I still think that's a really good idea, although I have moderated on other elements. But so that was like really this massive thing that ingrained into me. I have to be good with money so that I don't harm my relationships and so they don't harm my future and create all this uncertainty in my life. And I had the good fortune of, at the age of 22, I got this job. I loved talk radio, ended up working in talk radio for many, many years for a guy named Clark Howard. And he was a nationally syndicated personal finance talk show host. And working for him was like this crash course, this mentorship of sorts in personal finance and investing. And so that to me was like, opened my eyes to all of the good things you can do with money, and not just the ways that you need to like be incredibly frugal and hoard money, but I think all the benefits that money can provide and the ways that you can use money in a positive way.
Yeah, I'm glad you mentioned the radio show, because I remember listening to you on a podcast years ago and you mentioning that. So I knew that was in your background. And you talked a little bit about it, but I'm curious, were there specific things that working there and working with him that you can look to be like, oh, this is why I do that thing? Can you draw on some specific examples of where that influenced the way you think about money and investing?
Yeah, I mean, when I first started working there, I didn't really know what a 401k was. I was 22. I was fresh out of college. I had like zero financial education. I didn't know what a Roth IRA was. I couldn't tell you what the contributions limit were. There were things I was trying to pay off my student loans as quickly as possible. And then I realized after a little while of working for Clark, wait a second, I was one of those fortunate people who had a sub 2% interest rate on his student loans. And then I was like, does that really make sense for me to keep trying to get rid of those as quickly as possible? Or are there other things I can and should be doing with this money? There were, a million things I learned working for Clark. And then just that passion developed, because you asked about the podcast, and that passion really turned in, or just that interest turned into a passion. And so at some point, my buddy Matt, my best buddy Matt, and I were talking like, what do we do when we get together? We drink a beer and we talk about money. It's something that we were both really interested in and passionate about. Matt was a small business owner. Me working for Clark in the money media space. We're like, let's try to create a podcast. Let's try to do something, the two of us. And it's to get to do that with your best friend is pretty fantastic, pretty fun. It makes the work
I wouldn't know.
Oh, you can do it.
It makes it feel like less of a lift, right? To get to do the thing.
Yeah.
You're like, oh, I'm going to show up and hang out and talk about a subject I care about with my best buddy, instead of showing up solo to the microphone or something like that. And just, you're just more likely to be prepared, and you enjoy it. It's just more enjoyable. So getting through that with him, I guess we've been doing it for almost 7 years now.
Yeah, no, Absolutely. Absolutely spot on. Jeff and I, our listeners know, but just for your background, we met basically during the pandemic on social media and started interacting a little bit. And then we ended up having a couple of phone calls and started to establish that relationship. And it kind of came to the same thing. It was, we were really aligned on a lot of things. It was something that we both really enjoyed talking about, and other people in our lives don't necessarily enjoy having these conversations. So, it was nice kind of having, being able to pull the oars in the same direction. I want to circle back to something you said. This is where I'm going to take the show on a tangent. Jeff, you're welcome. But it gets back to thinking about money. One of the, as you were talking about your history with your family with money and where those early seeds about frugality were planted, it got me thinking about some of my own experiences and mistakes. And
let's list them all right now.
Oh man, we don't have that much time, but we can have you back on next week.
Okay.
But if anyone wants to, they can go listen to just about any episode. Let's talk about it.
So, but to me, it feels like your early relationship with money was really punitive, right? And so there was a lot of negative associations with money that carried over into your early adulthood and the way you thought about money and treated it.
Yeah.
And at some point you made that transition of really, and it sounds like working with Clark Howard and being around that group of people that view money as a tool and how you can use it to leverage your life in positive ways. That was a hard lesson for me to learn, to really separate the emotions from money and thinking about money as a tool that I can use in some way, hopefully for good in the world. I'm curious, what do you remember specific things that happened that really opened your eyes about, okay, this is a tool that I can use to make my life better now, not just being so focused on how it can keep your life from being bad?
Yeah. I think that's a good, I was built up, I had this scarcity mindset, right? And so it was kind of like, I have to do everything I can to maximize every dollar. And I have to, I have to gain future security as quickly as possible. And part of my thing wasn't even I have to make as much money as possible. I was working in talk radio. Like, you don't make a lot of money working in talk radio. I was like, I want to do work that I enjoy, because that was another thing that my dad struggled with, was that he wasn't doing enjoyable work. He wasn't making much money, but it wasn't like he loved his job either. And so I was like, I'm willing to not make tons of money as long as I get to enjoy what I do every day. But yeah, when it comes to like getting over that hump, I think, and seeing the good that money can do, like it takes time to find that balance. At least it did for me. I think marriage was a big part of that. My wife kind of like pushing me to say, hey, this is great. Future financial security is a wonderful thing, but how are we going to, what do our lives look like now? And you can't just think about how glorious your 60-year-old or 65-year-old self, that future is going to be. You have to incorporate some of those things into the here and now. So that was, I think, one thing was really my wife's influence. And then I think that my buddy Wes Moss has this study about the happiest retirees. And he talks about the people who are happiest in retirement are the people who are doing some of those things along the way that they enjoyed the most. Like, they had more, I think he calls them core pursuits that they were fond of. So whether that is, hey, I'm into long distance running, or I'm into disc golf, whatever that is, like enjoying those things in the here and now. And so that was another thing for me, was like, well, actually my hobbies aren't terribly expensive, but I need time to do those things. And sometimes having that time comes with saying no to money, to earning more money. So all those things. And then I think the other thing, I remember having this conversation with this guy, Ken Honda, who's a personal finance writer from Japan. And my wife and I were set to do a renovation on our house, and it was really expensive. It was like the biggest check I'd ever written in my life. And I remember and I'm not prone to anxiety, but being so anxious writing that check and kind of freaking out after it was done. I like to think of myself as like a cool, calm, collected fella. Getting to that table, I was like, this is great. This renovation is going to be awesome. And I could foresee the light at the end of the tunnel, how great the house was going to be at the end of 6 months. But writing the check totally undid me. And I remember Ken Honda saying that to be thankful for the money that comes in and comes out of your life. And I remember thinking, I can be anxious, and I can be nervous, and I can let this renovation be this pile of nerves built up in my body, freaking me out every step along the way. Or I can say, man, really thankful I have the money to write this check to do this thing that we have set as a priority in our lives. And so it was kind of like a mental reframe, a mental shift. And I think for me, that helped. And I have to go back to that all the time, because I become a nervous Nelly at times still when it comes to money and spending money. And my wife sometimes has to prod me in that. But I think that's one of those like real moments that stood out to me, where I began to view some of my spending differently. If it's intentional and it's thoughtful and I have the money, quit freaking out about it.
You hit on something in that answer, Joel, that I wanted to circle back to, because it's something that I think about when in my day job, I work in a school district and I talk to younger teachers who are at the beginning of their journeys, 21, 22 years old, just out of college. And if it comes up that I know anything about investing or retirement accounts and things like that, sometimes I'll have those conversations. And the thing that I'm never sure how to approach, and I'm curious if you've talked about this either on the podcast or if people have reached out to you. The thing that I struggled with when I was younger was feeling like I'm at the beginning of my career, I don't have a lot of money, and therefore I can't invest it because I need it to like just get by. And Jason actually helped me think through this. I wish that he had said this, someone had said this to me when I was that age, the whole idea of pay yourself first. Like if I had just built the habit when I was 17 and had a summer job of like 10% of my income going straight to an S&P 500 index fund, I probably just would have grown up with that being normal. But
yes,
stepping into it, I was excited to have a paycheck for the first time, like a real paycheck, like a grown-up one. And then I was like, but I got to pay my rent and I have to make sure that I can, do my car payments and things like that. So when you're talking about money with people who are at the beginning of their career, or maybe even just later in their career, just don't make a lot of it, how do you think about encouraging people to get into saving and investing when they just don't have a ton to get by on?
Yeah. And I can sympathize. I found myself in that position in those early years. My first radio jobs were part-time. And even when I started working for Clark, a nationally syndicated radio show, you would think, now I'm in the big time. I'm a producer for a nationally syndicated radio show, and I was part-time and I was pressure washing houses on the side. And so I was certainly not raking it in, but I found that, and not on every salary, but on most salaries, there are ways to invest a small amount. And you're right. It's like kickstarting a habit that will continue for decades to come. Even if it's just a few percentage points of your paycheck, putting that into your 401k, getting the match, getting the doubling, essentially, if you have that available to you, it kickstarts a litany of other great habits in your life. But that one habit in and of itself can and will pay massive dividends down the road. And it's one of those things too, where I think it's tough to see the progress in those first, you don't see any progress in months, basically, right? In the first few years, you see very little too. And it's only looking back, like decades down the road. And so I've been an investor now for almost 20 years. And now I'm at the point where like I see market moves and I'm like, oh my gosh, like
the numbers get big, right?
It's crazy. You heard people say that 20 years ago, or I heard people say that 20 years ago. And I was like, decades down the road, your money's going to work harder for you than you do for it. And I was like, I guess I just have to trust that that's true. And it is true. You will get to that point, but it's a slow and steady process, but you got to begin. And I think some people discount the value of investing $20. That's why I hate lottery tickets. They're about to ramp up the price of lottery tickets from $2 to $5. And I think people think of it as this nihilistic thing, like I'll never be able to build wealth, so I might as well just go for the jackpot.
Yeah.
I don't think that's true. I think that $5 matters when you're investing. If you're doing $5 a week into lottery tickets, that's just one lottery ticket a week. Like some people are doing a lot more than that.
Right.
But if you're putting that money into lottery tickets instead of into the market, you're screwing up, because that will, it's not going to have some sort of instant impact, but it will over time have a meaningful one.
Yeah. That's round numbers here over 40 years. That's about $65,000 if it compounds at the market's annualized rate.
Yeah. That's not nothing.
Yeah. I just did that in my head too. I'm pretty impressed with myself.
So for all our listeners, if the math is wrong, please reach out to us and tell Jason his head math is bad.
Hey everybody, we'll be right back, but first a word from our sponsors.
FinChat.io is the complete stock research platform for fundamental investors. They have all the standard financial data on more than 100,000 stocks globally. But beyond that, they have company-specific segment and KPI data on around 1,800 stocks. So for example, do you want to see NVIDIA's data center revenue growth? They've got it. Do you like to track Apple's iPhone sales? They've got that too. Or how about nights and experiences booked for Airbnb? You guessed it, they've got it. And they just added around 8,000 ETFs and mutual funds to the platform. The breadth of FinChat's data is truly one of a kind. I use FinChat every single day as I'm researching the stocks in my portfolio, specifically when I want to see how they're doing on KPIs that FinChat is famous for. So to get 15% off any paid plan, go to finchat.io/unscripted. That's finchat.io/unscripted to get 15% off any paid plan today. The link will be in the show notes. Hey, Investing Unscripted listeners, this episode is brought to you by our friends at Yellow Brick Investing. Yellow Brick is an aggregator of the best stock pitches across the internet. By tracking thousands of blogs, newsletters, fund letters, podcasts, and more, they're able to collect and summarize the best stock pitches from all over and bring them to you in one single place. Think of it like a modern value investors club. I have to say, this is pretty cool. I can just type in the company I'm interested in and get a bunch of different stock pitches from across the internet. It helps me think through new ideas and find opposing points of view on the stocks I'm interested in. And the best part is, access to Yellowbrick is completely free. Try it for yourself. Simply go to joinyellowbrick.com and search a company or ticker you're interested in. You're bound to find a great report on just about any company. That's joinyellowbrick.com.
Yeah. So a couple things you said there, Joel, that really, I think, resonated with me. Going back to writing that check for the renovation you were talking about, it got me thinking about, we just did a patio here, and I was thinking about writing the check for the patio, smaller than a renovation, but still hard to write that check. But the thing I was thinking was, it's really hard to write that check, but at the same time, if you're financing that, it's so much easier just to sign for that loan, right? Because you're thinking about that monthly payment, and that number just feels so much smaller, even though it's really a bigger number, right? When you finance it. And it got me thinking about the tension between, you started talking about the things that we can do automatically, like the 401k contribution, the percentages that seem small, that can be big, and you can find the money. Yes, there are people in poverty, right? There are people that face financial realities that a lot of us don't, right? And we're not making light of that, but speaking to the reality for most people that are going to be our audience, you have flex. You have some ability to make things happen automatic for money that you don't really need, that can disappear and it won't change your life at all. That is money for future you, right?
Mm-hmm.
And it got me thinking about like the tension between the things that you have to be mindful about versus the things that you want to automate in your life. And I'm curious how you approach that.
So yeah, I just want to speak to one thing. I think compounding can work in either direction, right? And what you're talking about essentially is small bits in the positive direction goes a long way, and small bits into, like, the average person has something like $6,000 worth of credit card debt, recurring credit card debt that they don't pay off. Or you're talking about being okay. Like, we just live in this culture now that's become accustomed to being payment buyers on everything from cars to renovations. Like, it's all about, and I mean, it's buy now, pay later. That's where that phenomenon comes from. Yeah. People are willing to say, I don't know, I guess I'll put my blue jeans on a 4-month payment plan. And it's amazing how you have to be, as the way we do money in our predominant culture gets worse and worse and worse. You look even more like a salmon swimming upstream, doing just kind of like normal basic stuff that wasn't considered ridiculous, or like paying cash for a car or something. It's like, who does that anymore? Like, why would you even suggest that someone does that? Because there are loans for that. And so why wouldn't I just go and get the best loan possible and pay it off over 6 or 7 years? And it's because you get into that mindset and you buy something more than fancier than you otherwise would. You, instead of sticking to stuff that's actually in your means, you buy more clothing or plane tickets or something like that than you otherwise could afford. And you forget about that. When you look at what's happening with cars too, it's incredible. The people that buy a car on with an 84-month term, right? And then they want to upgrade the car 60 months after they bought it, and they roll the rest of the loan into the new car loan. And so they're massively upside down in the next car that they get. And we've just said that that's normal. And I just don't think that's normal. And I think if we just combat kind of what we've considered to be normal, and we talk about what actually is normal, and maybe we push even a little more into that counterculturally abnormal way of living life, like, people will be financially healthy in a much more significant way. But we've all bought into this way of living that completely screws up your ability to reach financial independence.
One of the things that's crept along that reminds me of, and then I've got an actual question after we finish commiserating over these real financial issues. It got me thinking back when I was in my mid-20s, and I bought the first car that I ever bought on my own, used car. And it was a 5-year loan. It was the only way I was going to be able to buy the car. and the dealer, they tried to upsell me to a different car. And he said, well, I can get you the same payment. Okay. And they were going to go from a 60-month loan to a 72-month loan, right? Keep me the same payment. And I was thinking 6 years for a car. And now, we're talking 7-year car loans.
Mm-hmm.
Yeah. Now cars are more reliable and they do, stay on the road longer and all that, but still it blows my mind that this continues to be more. It's not just normal. It's more normal, more and more normal.
The other piece of it too is what I've noticed in just talking to like friends and other people who do these things, like use a lot of debt to finance their life. What I've noticed is it's typically the people who already have debt who just try to go get more debt.
Mm.
You know, and I'm going to defend myself a little bit here because I'm not, it wasn't until recently that I really kind of understood how you can actually save enough money to pay for a car. Like that seemed like it's absurd to me when I was in my 20s. Like how will I ever have $40,000 in cash or 30, whatever it is, if I want to buy a new nice car, right? And I think that's a mindset for younger people. Like when you're only making whatever, 40,000 a year, the idea of saving even 20,000 to get like a used car is like mind blowing. So like
100%.
So I actually don't think in some instances using debt to get a car loan or even doing like a big renovation is the worst thing in the world. But I think most people don't actually do the math on how much more they're paying.
Right.
And they think to themselves, especially when interest rates were low, oh, this loan's only 3.99%. Like that's not a lot of money. They don't take the time to take the price of the car and multiply it by the interest rate to figure out like how much it actually is.
Amortize it out.
Yeah.
Look at the document that they're legally required to give you that gives you the number.
Right.
And I'm not an anti-debt crusader. Like I have a mortgage on my primary residence. I have mortgages on my rental properties. And I think some people there's the kind of mindset that all debt is bad. And I think some debt, some smart forms of debt, there aren't like a ton of them, but there are some that can help act as jet fuel for your ability to build your financial future. I was talking about that student loan debt that I was like, focused on pretty intently early on in my wealth building journey. And if I had focused instead on putting that money in my Roth IRA, my net worth would be higher today than it would than focusing on paying that student loan, low interest rate student loan debt off. So you have to be thoughtful about it. And I don't think it's necessarily just a math thing, although you do want to look at the math as well. It's partly psychological. But if there are some people who will lead you to believe that paying off your debt is the smartest thing to do, and until you've paid off all your debt and until you can buy a house in cash kind of thing, then you shouldn't be investing or something like that. And that's going to delay your investing journey, and that's going to delay your ability to build wealth too.
Yeah.
So a lot of these things that we're talking about are lessons that you can learn from other people, but I'm a firm believer that the reality, because we're humans and humans are stubborn and kind of dumb in a lot of ways, a lot of times they're lessons you can really only kind of learn on your own, making the mistake or facing the reality and figuring it out. So I'm curious, thinking about lessons that you've dealt with in your own life, are there things that you think generally you're probably going to have to make the mistake to learn?
I do think that you're right. I think you can often and most of the time learn from what others are teaching you or from maybe the bad beats that others have suffered. Like I don't think, like I heard somebody the other day say that, well, Gen Z is going to have to learn investing mistakes, the YOLO style of investing. They're going to have to learn it through like trial and error and getting burned. I don't think they have to. Like, I don't think you have to invest haphazardly and then say, oh, now I learned my lesson. I think you can learn your lesson before you do those things. And that's my goal, is to hopefully help people on the front end. But I do think that there are other things that, especially when it comes to kind of more innate personality realities, that you're going to have a more difficult time. You probably are going to need some trial and error. I think there really are. Some people are, whether it's nature or nurture, whether it's just ingrained from the womb or whether it is from like those early childhood experiences, you are going to probably be more in the frugal camp or more in the spendthrift camp. And I think you're going to, I actually think of myself as a spender who had to moderate, right? And it's harder for me maybe than the person who's like natural inclination is to frugality. So I was a spender, and then I went through all those things and I was like, I have to force myself to be this thing that I don't necessarily want to be. But I think that's probably the most difficult thing for people, and the thing that they're going to have to combat the most, with the most fervor is those natural inclinations that they have that might go against the best interests of their money and building wealth.
Yeah. The knowing thyself, I think, is a huge piece of that. It's funny, like the thing that I think about, I don't know. Part of me thinks you do have to learn some of these lessons. Like there's a bunch of things in my past where I was very close to learning a very bad lesson. Like I flew a little too close to the sun a couple times when I was younger and got bailed out because I grew up, I have a privileged background, like not super wealth in my family, but I always knew I kind of had a little bit of a backstop if I got into any real trouble. And during the early 2000s, like real estate bubble, when you could basically get any mortgage you wanted by just showing you had a pulse, I very quickly bought my first house and then realized not too long after that, getting the mortgage payment covered in the summers when I wasn't getting a paycheck because I was a teacher was kind of rough. and I was able to borrow a little bit of money to kind of bridge that gap. But that, like, for me, that's something that has always stuck. And I don't know that I would have completely learned that lesson. I knew that lesson, right? Like I did know that. I knew I shouldn't have gotten a mortgage that was beyond what I could afford. And I don't want to say I was a victim, but when you're 25 or 23 and someone's like, you can't afford this.
Yeah.
Here's an official paper that says you can. You're like, oh, all right, I guess I can afford that.
I think that's a really important point. I think that is something that happens to a lot of people. And so I'm not saying even that it's easy, right, to avoid all those things. And I think a lot of people do fall victim because financial literacy in this country is abysmal. And almost fortunately, we're getting more and more, high schools in states around the country, our kids are having to take a personal finance course in high school in order to graduate. How helpful is that going to be? That remains to be seen. But I think you're spot on that a lot of people do end up learning through difficult circumstances or through, encountering it themselves because nobody taught them differently. I even go back, I was so fortunate to get to work for someone who taught me proactively about money because it was my job. I was like literally producing a financial advice radio show. But if I had just been let out into the world based on what my parents said I probably would have been frugal, but man, I wouldn't have known anything else about money or proactively building wealth. Nothing. I'm constantly amazed when I meet 24, 25-year-olds who are on the right path when it comes to their money. And I'm like, how at this young of an age are you there already? It boggles my mind because the only way I was there is because my day job allowed me to get there. So I think that's part of my passion is I want to help people avoid some of the mistakes that are common out there when it comes to how people handle their money. But I think you're right. Most people are going to make at least some mistakes and hopefully they can correct, before it gets too bad or before they dig themselves in too big of a hole. But most people don't have parents or really any outside influence who are kind of shepherding them in the right way because most of their parents don't know any better either.
Yeah. Yeah. And it's interesting because for me, like I have two parents who had pensions. So and good, like rock solid pensions.
Yeah.
So I don't think it was ever on their radar to like invest beyond that because they both had them. And I think some of my grandparents did too, because that was very common generations ago and is less so now. So, all right. So I want to go in a slightly different direction because, we do talk a decent amount about personal finance on our podcast, but we talk more about investing and stocks and things like that. So I know you guys are big proponents of, for most people, just indexing into an S&P 500 index fund or ETF like VOO and saying that that's appropriate for most people. And Jason and I feel the same way. But our listeners mostly are here because they want to do a little bit more with that in individual stocks. And I think our point of view, and I'm curious what your thoughts on are, we talk a lot about, we love it. Like it's one of our favorite things. So like we understand why people want to do that, but you have to go into that willing to do the work and spending the time and all that kind of stuff. So I'm curious, you personally, do you invest in anything other than index funds? Like, do you dabble there at all? I'm just curious, like where you land on that for yourself and how you think about it for other people.
Yeah, I do. I do a small amount of single stock investing. I own a small amount of Bitcoin and
good man.
Right now, that's looking really good.
It's looking really good right now. But the truth is I don't own enough for it to make a massive difference in my bottom line. For me, it's more of...
Well, that's a good way to manage the downside risk too, right? You get to scratch an itch, but also not risk your family's future.
Yes. And so that's really what I try to eat my own cooking on this when it comes to how I think and talk about investing in individual stocks or investing in alternative assets. I guess in some ways, like most of my investing exposure is to real estate, right? So I own a number of rental properties. I have some money in some real estate syndication deals. So that is like if you're looking at like how much exposure I have to real estate versus the stock market, it's vastly more exposure to real estate. But it's something that when I bought it was a different time. And so I think you need to take the market conditions into account. And I try to warn people against listening to real estate influencers who want to make it sound like it's super easy and they're going to make big bucks. And when it comes to like single stocks and alternative investments, I do think it's okay to put a portion of your portfolio there, especially if you are the kind of person who's willing to do the work and not just be like, I watch Netflix, maybe I should invest in it. Like you should do more due diligence beyond just that sort of knee-jerk assumption. And I'm okay with it, but keeping it to, I think, 5% of your overall portfolio makes sense. And I like the idea of having it with a different brokerage firm than where you have your 401k, your IRA, stuff like that. So it's almost like siloed off and you go specifically to that other place to check your individual stock holdings. And also having a more long-term mindset when it comes to that sort of investing too. I think sometimes when you talk about individual stock investing, we're talking about day trading. That's at least what a lot of people assume.
Yeah.
And I think you can invest in individual stocks and potentially outperform if you're thinking about investing for the long term. That's from a tax perspective, but also from just a smart investor standpoint, because if you truly believe in Starbucks, they've had a really tough time recently and their stock has shown it. But does that mean that Starbucks isn't going to be around for the long haul? I don't know. I don't drink Starbucks, but I know a lot of people do. So I think you have to have that long-term mindset, even if you're investing in individual stocks, and you have to be willing to dedicate the time. If you've got the interest and you're doing the right thing with the vast majority of your investment dollars, go for it.
Yeah. I think one of the things people forget about trading stocks is you are literally going up against professionals. And just like any endeavor, I promise you that you're probably going to lose to a professional if you are playing a game against them that is what they do full time. It's frustrating to me because we go through these periods of very, very strong bull. I don't know the exact number, but I know there's a lot of 2024 that's like 2020, where I think it was something like 70 or 80% of stocks made money from the bottom in March 2020 through the end of the year. And I know it's in the 60% range. I don't know the exact number this year. It's just been a really good year for almost all stocks. And it gives people false confidence that they know what the hell they're doing,
right,
when it comes to trading. So,
well, and the other thing, when you look at what individual traders do so much of the time, we talked about Bitcoin being on fire right now. Think about the Cathie Wood's fund ARK, right? And when did it see the bulk of inflows? When it was at the top. Right. So it starts to gain a reputation. It gets a lot of headlines on CNBC. Cathie Wood becomes low key famous. And then Joe, investor on his couch, says, maybe it's time for me to jump in on this gold mine. And they get in at the exact wrong time. And so I think that is a massive problem that individual investors are likely to fall prey to. And so you have to be really careful and thoughtful about your timeline, about what you're investing in, about why you're investing in it. You have to have conviction, because otherwise, you're going to be following trends, and you're going to be late to that trend, just like I am when it comes to fashion. So,
hey everybody, we'll be right back, but first a word from our sponsors. Heads up, folks, interest rates are falling, but you can still lock in a 6% or higher yield with a diversified portfolio of high yield and investment grade corporate bonds on public.com. You might want to act fast because your yield isn't locked in until the time of purchase. Lock in a 6% or higher yield with a bond account only at public.com/investing unscripted. Brought to you by Public Investing, member FINRA and SIPC. As of 9/26/24, the average annualized yield to worst across the bond account is greater than 6%. Yield to worst is not guaranteed, not an investment recommendation. All investing involves risk. Visit public.com/disclosures/bond-account for more info.
Hey, Investing Unscripted listeners. My name is Brett, one of the hosts of the Chit Chat Stocks podcast. If you love Investing Unscripted, we think you will love listening to Chit Chat Stocks. On our show, we research individual stocks, interview investing experts, and, well, chit chat about investing every single week. From hot stocks such as Nvidia and Celsius to hidden small cap gems, we have something for every type of investor. Follow the Chit Chat Stocks podcast on YouTube, Spotify, or Apple Podcasts and start discovering new investments today.
Well, nice. Well played. Yeah, me too. But there's something on there that's really timeless that you said is people trying to get in at the perfect time and then try and get out. You know, fear and greed is so powerful as drivers because they fire the parts of our brain that the pleasure and pain parts of our brain. And talking about Cathie Wood, and of course, ARK has really struck. It's been a pretty good year for ARK, but overall, right, it's still well down from its highs and that sort of thing. But what happened there with inflows was not unique to ARK. So Peter Lynch, probably the greatest active investment fund manager of any any kind of regular fund that people can invest in since they've existed. Incredible, not just his returns, but his outperformance versus the market. The average investor in the Magellan Fund when he ran it underperformed the S&P 500.
Yeah.
Which is stunning considering how much outperformance that fund generated. But it was exactly what you're talking about. The fund inflows would happen near cyclical peaks. The market would do its thing. The fund would lose value like every fund does when the market turns down, and people would head for the hills, right? Humans are so bad at investing. We're so bad at it as a behavior. And that's why I think, Joel, you're spot on in the things that you guys talk about. And we try to do the same thing with frameworks to make people think versus rules to tell people what to do. Is you need to stop and think and then act in your best interest. So one of the things I want to talk about briefly that you've done is learn how to use leverage in real estate, because it's one of the areas where you can actually invest in real estate and use leverage. And sure, your VOO in your 401k or your Roth on a percentage basis might be up a ton over the past 10 years, but you probably made more dollars on real estate simply because the size of the deals and using leverage.
For sure.
So I'm curious about real estate and how that fits in, and how you think for the average person that maybe has gotten to a point where maybe they have enough wealth that might be thinking about rental properties or something like that. How would you think maybe they would think about it?
That leverage is a double-edged sword, right? And so you have to be really careful using leverage. I think that is one of the things that makes real estate returns potentially superior, is if you are wisely using leverage. And so I hear a lot of people talking about some really riskier strategies of buying real estate. I was always, and I still am of the opinion that you should be saving up a significant chunk of the purchase price, the down payment, right? So 20-25% down is what I want people typically bringing to the table when it comes to a property they're buying. And that means, yes, you are using leverage, but you're not over leveraging yourself. And then my goal over time, as the value of the property goes up and as I pay down the debt, my numbers look a lot better, and I'm not nervous about if there were to be a market downturn. Well, my goodness, am I going to owe more than the home is worth? So yeah, should people be investing in real estate? Well, I'm not actively investing in properties right now. And I don't think that means it's not, I'm just I've got other things going on, and it's also harder to find a deal. So you have to be careful, I think, at this point in the market where it is much harder to find a good deal as a real estate investor. The numbers are just much harder to make work. It doesn't mean that it's not possible, but I think you have to be really careful. And you also, again, you have to have a really long ownership timeline, because the worse the numbers look, the longer it's going to take for that rental property, I think, to make sense for people. So yeah, I guess, like I said earlier, there's so many influencers out there who want to make it sound like tiny down payments, leveraging to the max, you're going to be a real estate all-star. And it's possible. I mean, when you think about it, if I were to go back and have only put 3.5% down or 5% down on all those properties, the numbers would look even better, right? Instead of buying that $250,000 house with $50,000, now I'm buying it with $12,500. And so my return, now that it's worth $500,000, let's say, is so much more because I put so much less money into the deal. But the flip side is, you've got a higher monthly mortgage payment. Is your rent going to cover the mortgage payment and all the money you have to put into the property? So I just think it's unwise to over leverage yourself. It is one of the things I do that can be helpful about real estate and juicing your returns to a certain extent. But you can also take advantage of that to your own detriment.
Yeah, it's like rocket fuel, right? You can add more rocket fuel and you can go faster and you can go farther. You can also blow everything up.
Sure. Yes.
And that's leverage when it comes to real estate.
And there's so much hindsight bias in some of those things, right? Like, so you here in 2024, Joel, can look back at maybe a property you bought 20 years ago or 15 years ago and say, oh man, the market didn't crash. I should have put down less, but that's hindsight. You don't know if it's going to go that way in the future.
Oh, if we could all go back in time, I mean, I would have bought a lot more properties in 2010, 2011. Yeah. And I would have found a way to get that money, even if it was, high interest debt or something like that, like because I knew what was coming. Right. But we just don't. And so you have to protect your downside as an investor too.
Yeah, absolutely. All right, let's pivot to some more fun stuff as we wrap up here. So you guys talk about personal finance and you drink craft beer on your show. So we're gonna do a Charlie Munger inversion here again. If you have to drink cheap macro beer, what's it going to be?
So the only time you'll find me drinking cheap macro beer is at a concert, like a music show. So, but I will drink PBR or Miller High Life if I'm out seeing a favorite band.
I like that. A lot of High Life in college for me. I think I'd go Coors Light or Miller Lite right now. Okay. I had to go cheap macro. What about you, Jason? We don't talk about your cheap macro beer of choice.
Coors Light.
All right.
It's like water.
It's true.
Hot flavored water.
Water.
There you go.
All right. So we're going to do some frugal or cheap with you here, Joel. We're going to throw some scenarios at you. You're going to weigh in if these things are frugal or cheap. All right. Because I know this is another construct you guys like to do on your show. So my first one is driving out of your way, waiting 30 or 40 minutes to get gas that is 30 cents per gallon cheaper at Costco. Frugal or cheap?
Cheap. And I love Costco. I love it. I do love Costco. But no, I think people overweight the expense of gas in their lives. The thing that's more expensive is the insurance and the vehicle, the depreciation. Nobody talks about depreciation of the car. Like I bought this $40,000 car and in 2 years it's going to be worth $25,000. I just lost $15,000. But you're willing to drive an extra 30 minutes to save like $3 on gas? Like we're majoring on the minors there.
Yeah, agreed. All right, here's the next one. You're out to eat with friends. All you had was a salad and some water, and everyone else was ordering steaks and beer. If you don't want to split the check, if you chime in and say like, listen, I'm not splitting this evenly, that's not fair. Is that frugal or cheap?
I think it depends on where you're at in your financial journey. 12 years ago, I would have been so pissed. if I was like getting water and really paying attention to what I ordered, then we tried to split the check. I'd be like, no. I'm trying to do the right thing over here. At this point in my life, though, I'm not going to speak up and say anything because it's just a drop in the bucket, fortunately, because of all the financial progress I've been able to make. So I think it depends. You have to be willing to be able to be honest with your friends. If it really is an annoyance to you or you really financially can't afford it, speak up and say something. And I think your friends will understand. But also, if you are at the point where you can afford it, like, I don't know, think of it as just being able to be generous with your friends.
I think about it on a continuum, Jeff, Joel, where if it's with my friends, I'm going to raise hell. I'm absolutely going to not pay for their steaks. But if I'm with people I don't really know very well, especially if I don't like them, I'm going to flex and I'm just going to pay the tab.
Oh, there you go.
Yeah. I'm a horrible person, Joel, if you haven't figured that out yet.
I could tell from the first moment I met you.
Yeah. There.
Well, I actually like both of those answers because I always say if I were insanely wealthy, if I just had more money than I ever needed, that's exactly what I would want to do. Mm-hmm. Like not as a flex necessarily, but just like that's how I'd want to show my generosity. Like I would take people out to go out to dinner with my friends and just always pay. That would be like the way that I would like to. That's me like being charitable, I guess.
Yeah, no, it's funny. I was being tongue in cheek, but actually I do. I love doing that, going out with people and then just randomly I'll get it.
Unless Nvidia stock's down like 20% that day, in which you're like, no, you got to take care of yourself.
My Nvidia shares were called away because I was selling weekly calls and I sold them for a lot less than they closed for.
Yeah. So now everyone else has to pay their own tab.
That's right.
Yeah.
That's right.
Yeah. That was a buy your own tab week.
All right. Here's the last one, Joel, because I actually saw someone do this. So I need your take. It was a work party at someone's house, but it was catered in the backyard. and party's wrapping up. There's tons of leftover food. And someone asked if they could take a leftover box.
Love it. Come on, what are they going to do with it? It's either going to get tossed out. They don't have enough room in their fridge. You're helping them. So if you're saying, hey, listen, if you got extras, and like, I wouldn't be like, I wouldn't assume that they owe it to you. But if you feel like you're helping them out by taking some of their extra food and you're feeding your family for a couple nights because of it, I think that's a great suggestion. I think that's frugal.
All right. Nice.
I got two. We'll go with the more obscure one first. You're on vacation, staying in the friend's rental property that he's letting you stay in for free, that's a half an hour away from the theme park, instead of just ponying up for the near resort hotel that's 5 minutes away.
Oh, I mean, I'm taking the free place and driving all day, every day.
Thank you.
Yeah.
Thank you. It's a lot of money.
Are you going to send this episode to someone, Jason?
It's a lot of money.
Dude, lodging is theme parks have gotten so expensive. Trying to go to Disney it's like throwing a Molotov cocktail at your wallet. So you might as well get the free lodging, and then, then you can splurge a little bit on eating at the theme park or something like that.
See, that's what I said.
Yeah.
Theoretically.
We're cut from the same cloth, Jason.
All right, I've got the last one here, Jeff, and this is the oldest one. This is the one that everybody talks about: making coffee at home.
Oh, I'm a big fan. I'm drinking coffee at home 6 days a week, actually 7 days a week. And if I go out for a coffee, which is typically 1 day a week, it is it's additional coffee. Yeah,
it's extra coffee. Yeah, love it.
So
you're living your best life, Joel.
That's right. But I also think this is actually really key. There's the coffee shop millennial bashing, the avocado toast stuff just really does irk me.
Me too. Yeah.
But the truth is, I think you enjoy that experience more if you're not doing it every day. And I look like Monday mornings is when I go out to my favorite coffee shop and I get a flat white, which is my beverage of choice. And I get stoked on Sunday nights. I'm like, tomorrow morning's coffee day. For a while, I was taking my little man before school 1 day a week. They had these like little chinos. And so he would drink his kiddo fake coffee thing, and I would have mine. That wasn't money spent on coffee. That was an experience for us.
Yeah. That's a memory with your kid.
Yeah. But if you do it every day, like going through the drive-through of your favorite coffee joint to get your $6 fill, that to me, like, you're probably missing out on some of the experience, and it's becoming this recurring cycle of paying for coffee that's way more expensive than what you would spend at home. I don't even care if you want to drop like hundreds of dollars on like a dope coffee setup at home. Go for it. And then make it just an occasional splurge so you can actually enjoy it instead of just doing it on repeat because that's what you do.
Think of the shareholders, Joel. Think of the shareholders.
The way I think of it is this: like the times I have to get coffee, like I think of it as like when I have to get coffee on the road, it's usually if I'm rushed in the morning and I don't have time to make it myself, because I don't do like the Keurig or anything. I try to like make coffee. It takes time.
Yeah.
And if I can't, to me, it's if I have to buy it on the road, that means I had to get out of the house early because maybe I had a meeting or something I had to get to, and that's sort of like my gift to myself for like my morning routine being disrupted. I'm angry that I got to be out early, but at least I'll get to grab some coffee on the run, and that's like a little treat for me in that sense.
Yeah, I mean, everyone, you got to treat yourself every now and again. I think you just need to set aside the money to be able to do that, so you're not like that's what we do too. Because like with soccer and stuff like that with the kids, every once in a while we're like, we have to throw the game plan for making dinner tonight out. Like it's gone. What are we going to do? And typically it's Chick-fil-A or our favorite Chinese restaurant or something like that. And so you just have to budget for that, knowing that stuff's going to happen. And if it doesn't, then like you could bank that extra money. But you just have to be prepared for that kind of stuff, for the knowing that those inconveniences are going to happen at some point in time.
Find balance.
Yeah. All right. So let's wrap it up here, Joel. We've been talking about and referencing your podcast throughout the whole episode here, but to end, why don't you take a moment to tell people where they can find your podcast and where they can go if they want to learn more about what you and Matt are up to.
Sure. Yeah. The podcast is called How to Money. You can find it wherever you listen to podcasts, and hopefully it'd be a nice compliment to this podcast in your repertoire, because you need specific investing advice, but we try to run the gamut when it comes to kind of personal finance advice in general. And we release episodes 3 times a week because we're gluttons for punishment. And so you can find it wherever you listen to podcasts.
Awesome.
Well, I will say a couple things, Joel. I've listened to a few episodes. Jeff has listened to more than I have. but it's a different vibe. You talk about a lot of different things. I think it's definitely very complimentary. And I would suggest all of our listeners, if you haven't, at least give it a shot. That is for certain. They're also nice to each other.
Totally different vibe here. I don't know, Joel, we get feedback from listeners sometimes that they don't like that we're teasing each other all the time. We don't listen to the feedback.
Oh, no.
We adore those people.
You never listen to the listeners because you do what you want to do and they come along for the ride. And yeah, you don't change who you are. Don't change what you do for them.
No, it's our vibe.
Yeah.
It's our vibe.
Never change, Santoro. Never change. Joel, once again, for me and Jeff both, thank you for coming on. Really appreciate it. Love what you guys do. We're definitely all fighting the same good fight to help a lot of people money better. Thank you for coming on.
Thank you for having me.
As always, just a reminder, Jeff and I love to answer these hard questions about investing, personal finance, money matters, and more. I have great guests like Joel on to give their answers, but you have to remember, these are our answers. Your answers are your answers, and you need to come up with them. But you know what? As always, after 2.5 years of your nonsense, people, I still believe in you. You can do it. All right, Jeff, we'll see you next time.
See you next time.